Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from the New Zealand Herald on the 1st of November, New Zealand and Auckland house prices. Analyst CoreLogic says downturn is officially over. Topic number two from RNZ on the 31st of October. House prices set to rise 8% in New Zealand in 2024, according to Westpac. Topic number three, interest.co.nz on the 2nd of October. The Reserve Bank hints debt to income ratio restrictions could be put in place in the middle of 2024. Topic number four from interest.co.nz on the 30th of October. BNZ Chief Economist Mike Jones says the currently wide cost gap between building and buying a house should reduce, but much of this is expected to come via higher house prices. Topic number five from Stuff on the 31st of October. What will be the first issues for the new government to tackle? The first topic for this week in review from the New Zealand Herald on the 1st of November. New Zealand and Auckland house prices. Analyst CoreLogic says downturn is officially over. New Zealand's housing market downturn has come to an end, with the average prices dropping by $138,000 from their peak in late 2021. Auckland experienced the most significant decline during the same period. According to CoreLogic, the National House Price Index, a reliable indicator of price changes, increased by 0.4% in the last month, marking the first rise since March 2022. CoreLogic's chief property economist Calvin Davidson confirmed the end of the recent housing market decline, resulting in a total decline of 13%. However, despite this 18-month market decline, average house values in New Zealand remain high, standing at nearly $909,000 in October, which is approximately 25% higher than the pre-COVID levels of March 2020. Auckland is also beginning to recover, with its average value now at $1.26 million after a 0.2% increase in October. Wellington was the second most affected major centre, experiencing a 22% decline. Its average value is now $893,417 after a 0.3% increase last month. Tauranga was the only major centre to continue falling, with prices down by 0.1% in October, resulting in an average value of $1 million. The city saw a 15% decrease in average values during the downturn. In other regions, Hamilton's average value fell by $121,000 or 13%, Christchurch's value fell by $50,000 or 6%, and Dunedin's fell by $104,000, 15%. With prices now on the rise, Westpac's chief economist, Kelly Eckhold, expects a significant increase in prices next year due to high population growth driven by migration. Owen Bourne's property website One Roof, in collaboration with analysts Velocity, confirmed that the market had turned. Bourne's index showed that quarterly prices had increased for the second consecutive month. Property values in Auckland and Canterbury grew by over 2% in the 3 months ending in October, while New Zealand's average property value increased by 1.7% during the same period. Market confidence has been strongest in major centres, but it's spreading to smaller regional metros, with Whangarei, Napier and Invercargill all showing positive trends in October. A total of 566 suburbs recorded quarterly growth in the 3 months ending in October, which is an increase of 100 from the previous month, according to the index. Out of 927 New Zealand suburbs analysed, 32 have returned to or are close to returning to their record high values during the COVID boom. The incoming National-led government is expected to introduce policies that will further boost house prices, such as allowing property investors and holiday homeowners to use mortgage repayments to reduce their tax liability and avoid paying capital gains tax on homes resold after 2 years of ownership. Now, in my opinion, that phrase is quite misleading and antagonistic. So I would just like to say that National's policies around housing are unlikely to have a significant effect on the property market, other than potentially making it easier for investors to help them purchase rental properties, which is going to be good for tenants as well. with the foreign buyer tax on purchasing properties, that's limited to properties over $2 million. So it's unlikely to affect the first home buyer market. And where they made a comment about avoiding paying capital gains tax, I mean, please, we don't have a capital gains tax. But if you buy a property with the intention of selling it, you've always paid GST as well as tax on profit. So there was no loophole or anything like that. This is just a little bit, attention grabbing, in my opinion. Despite these potential boosts, according to the article, Helen O'Sullivan, Velocity's global chief executive of real estate, believes that house prices may not surge significantly. There you go, as long as interest rates remain high and continue to pressure homeowners' ability to afford new houses. So something else that I'd like to mention in this is that it very much depends on whether you're looking at medians or averages as to how dramatic the drop in values was. With marks like the house price index reports, those tend to be a much more accurate indication as to what's actually happening in the property market. However, the Real Estate Institute of New Zealand House Price Index is the one that we tend to pay most attention to, because the rest of them take the sale prices at settlement date, whereas the Real Estate Institute in New Zealand looks from unconditional date. So, quite often that can be 3 months before the others take that into account. So the Real Estate Institute of New Zealand House Price Index showed the market turning a few months ago. So yeah, that's just my personal opinion on that one as well, for those that are interested. Second topic from RNZ on the 31st of October, house prices set to rise 8% in New Zealand in 2024, according to Westpac. Westpac anticipates that inflation will likely exceed the Reserve Bank's target range of 1% to 3% throughout 2024, and there's a potential for the official cash rate, or the OCR, to rise in the first half of next year. According to Kelly Eckold, Westpac's chief economist, despite a decrease in imported goods and food prices, domestic inflationary pressures are still high. The bank foresees an extended period of below-average economic growth and foresees continued financial strain on households due to rising interest rates. Eckold also mentioned that the new government might implement fiscal austerity measures to balance the budget, which could help alleviate inflationary pressures. However, budget deficits are expected to persist, and the government will face tough choices due to population growth, increasing demand for essential public services and infrastructure. Westpac anticipates robust population growth driven by high migration rates, which will stimulate economic growth and also influence the housing market. While higher long-term interest rates will somewhat temper future house price increases, the impact of population growth will be substantial, resulting in an estimated 8% rise in house prices in 2024. The bank also predicts ongoing challenges for exporters in dealing with China and weak commodity prices, which will slow the expected rebound in commodity prices in the coming years. Westpac expects an additional OCR increase from the Reserve Bank in the first half of next year, with gradual rate reductions only starting in early 2025. The bank believes that further monetary policy adjustments will be necessary to ensure a timely reduction in inflation. Eckold acknowledges significant market uncertainties, noting that various factors could push interest rates even higher than their current forecasts, or possibly lead to earlier rate cuts. Close monitoring of data will be essential for both Westpac and the Reserve Bank to adapt to evolving conditions. So my thoughts on this are that, all of this is crystal ball gazing. No one knows what's going to happen with interest rates. Historically, all of the economists and commentators around interest rates have proven to be wrong more often than they've been right. My pick is that the Reserve Bank has probably done enough, and at the moment, swap rates are increasing interest rates. So, that's certainly increasing the interest rates on mortgages at the moment. So, in some respects, the swap rates increasing has saved the Reserve Bank from having to increase the OCR any further. Now, who knows how long that's going to continue? This last week, swap rates have started to come down. So, at some stage, the Reserve Bank may need to do another increase. I suspect that they won't because inflation is starting to track in the right direction. I think the Reserve Bank is likely to just continue to wait, worry, and watch and see what happens. But obviously, they have left it open to increase the OCR again if they need to. Now, it might just be wishful thinking on my part, but I actually think that the interest rates could start coming down a lot sooner than a lot of economists are predicting. I wouldn't be surprised if interest rates start to come down slowly in the first half of next year. But like I said, that could be wishful thinking on my part as well. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor. And these events are held live, online, or in person in our office in Ellerslie in Auckland. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. And if you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. And that's propertyapprentice.co.nz. Topic number 3 for this week in review from interest.co.nz on the 2nd of November. The Reserve Bank hints that debt-to-income ratio restrictions could be put in place in the middle of 2024. Reserve Bank, or RBNZ Governor Adrian Orr, has suggested that the introduction of debt-to-income, or DTI, ratio restrictions on banks' mortgage lending, set to become available next year, could be implemented with relatively flexible parameters. For years, the central bank has been advocating for the inclusion of a DTI tool in its macroprudential toolkit. In 2021, Finance Minister Grant Robertson granted approval for this addition, despite concerns from some politicians that it might hinder first home buyers' access to mortgages. With permission granted, the Reserve Bank of New Zealand has instructed retail banks to prepare for the potential deployment of DTI restrictions by April next year. However, the Reserve Bank of New Zealand leadership remains cautious about whether they'll actually enforce this measure. Assistant Governor Christian Hawkesby indicated that no definitive decision has been made regarding the implementation of a DTI ratio rule, although preparatory work has been conducted. The RBNZ intends to consult on possible implementation and initial settings in the first quarter of the coming year, leading up to the readiness date for retail banks. The reason that they gave the banks 12 months to have the systems in place to prepare for that by April was because the banks indicated they would need 12 months to do that. So that's where that April next year timeframe came round. If implemented, these restrictions could come into effect around mid-2024. However, in their announcement, the Reserve Bank did make it very clear that they've made no decisions around this. The Reserve Bank has been examining how the DTI ratio would interact with existing loan-to-value ratio restrictions, or LVR restrictions, on low equity mortgage lending and its potential impact on first-time home buyers. Governor Orr mentioned that DTI ratios might initially be established with lenient settings that do not immediately constrain buyers' access to credit. He emphasised that the current LVR ratio rules are not the primary factors restricting borrowing, but rather borrowers' ability to manage higher interest rates. Orr stated the debt-to-income ratio can be put in place, but that doesn't mean it'll be binding initially. He added that when they do become binding, it would be to control excesses in the economy. In an April regulatory impact assessment, the RBNZ acknowledged that the housing market was in a downturn, indicating no immediate need for DTI restrictions. However, the housing market has since stabilised, with most regions seeing price increases despite elevated interest rates affecting borrowing capacity. With an incoming government expected to pass property investor-friendly legislation and concerns about high migration and building costs potentially triggering a new housing crisis, the RBNZ might opt to impose DTI restrictions in anticipation of future property market risks. DTI restrictions would set limits on the amount of debt borrowers can take on relative to their income, curbing high-risk mortgage lending. The central bank aims to reduce the chances of a housing-related financial crisis in the future and potentially relax its LVR restrictions. The impact of these new rules on first home buyers will depend on the specific parameters chosen, but investors who tend to borrow at higher DTI ratios on average would likely be the most affected, according to the Reserve Bank of New Zealand. So, in summary, I think it's important to remember that the Reserve Bank has made absolutely no indication that they plan on implementing the DTI ratios next year. In fact, they made it quite clear that current test rates with banks are having a much stronger effect on people's ability to get lending than either LVRs or potential DTI ratios. So my opinion is that this is just another tool that the Reserve Bank can add into their toolkit to help keep house prices in that sustainable range where they're not causing any concern for the economy. I wouldn't expect an increase in LVRs or an introduction in DTI ratios until the Reserve Bank is trying to slow down the housing market again in the future because of concerns to the economy. In my opinion, we're a long way off seeing any of that. Fourth topic from interest.co.nz on the 30th of October. BNZ Chief Economist Mike Jones says that the currently wide cost gap between building and buying a house should reduce, but much of this is expected to come via higher house prices. The disparity in costs between constructing a new residence and purchasing an existing one has reached an unprecedented level, according to BNZ's Chief Economist Mike Jones. In his latest EcoPulse report, Jones conducted an analysis concluding that presently the average cost of our new 180 square metre house is approximately $200,000 higher than an existing one. He anticipates that due to a surge in inbound migration and the consequent demand for more housing, coupled with a decline in construction activity, the cost difference between new and existing homes will decrease. However, this is primarily projected to result from elevated house prices. BNZ economists are predicting that the modest increase in house prices will accelerate next year, with a 7% rise in national house prices expected by 2024. So they're a little bit more conservative than Westpac in their opinions about this. Jones explains it's generally more expensive to build, and their analysis indicates that the average new build premium over existing homes dating back to 1995 is roughly $65,000. Nevertheless, the current premium of almost $200,000 difference between between constructing and buying is amongst the widest ever recorded, which is approximately 3 times the long-term average. These figures, while indicative and subject to regional variations, align with anecdotal evidence. Jones combined average building costs with the median cost of land to arrive at its calculations. Jones selected an average house size of 180 square metres based on post-2000 standards. Without this adjustment, building costs would seem artificially lower compared to purchasing an existing home, as the average size of new constructions has decreased relative to existing properties, potentially with an increase in the number of apartments and townhouses that have been built in particular. This approach yields an estimated cost of around $980,000 for constructing an average residential dwelling, comprised of a land cost of nearly $400,000 and a building cost of $580,000. This compares to the median selling price of existing houses at $785,000 as per REINZ data, which remains below the late 2021 peak of almost $900,000. Jones contends that considering these figures, the general incentive for the average buyer to construct rather than buy is quite low. Jones emphasises that elevated construction costs, lower house prices, and high interest rates are currently acting against construction activity. The decline in new building consent issuance over the past 2 years is hardly surprising. Additionally, he notes that any remaining incentives for building, due to the new build carve-out from the 2021 removal of mortgage interest deductibility, may soon disappear since the incoming government plans to gradually restore deductibility to all properties. Jones observes that we're in the midst of a population boom fueled by migration, which has created extra pressure on housing resources, as evidenced by rising rents. If cost-related issues discourage new construction relative to existing homes, there is a greater likelihood of underbuilding compared to the population's requirements, exerting upward pressure on house prices as predicted. Jones expects that the current cost differential between building and buying to narrow as the rapid escalation in construction costs stabilise. Nevertheless, the reduction in this gap is projected to be primarily driven by higher house prices. Okay, so the gap's going to close because existing properties are going to increase in price and demand for new builds has been reducing with, essentially a bit of an oversupply at the moment in some property types. However, in my opinion, I think it's also important to remember that particularly first home buyers tend to be emotional buyers. So a lot of those first home buyers will be attracted to the new build townhouses because they're nice and shiny and new and no work needs to be done to them. And so, and especially with new immigrants moving into New Zealand as well, some of them are going to like the fact that there could potentially be lower maintenance for the first few years by buying a new build. Be careful though. If you're looking at buying new builds, always get a building inspection, even though it's new, because some of the new build quality is less than desirable. Topic number 5 from Stuff on the 31st of October. What will be the first issues for the new government to tackle? And there's the $1 million question, isn't it? And this afternoon, we should be finding out who is going to comprise the new government once we get the final results in of the vote counts. Gareth Kennan, the chief forecaster at Infometrics, has expressed his views on the post-election scenario in New Zealand, with the final vote counts and seat allocations due to be released at, my understanding, is 2 p.m. on Friday, the 3rd of November, so 2 p.m. this afternoon. The focus is going to be on whether or not New Zealand First will be part of the new government and the extent of their influence. While formal coalition talks have yet to begin, informal discussions between the parties are ongoing. National's already preparing essential policies for its expected mini-budget in December. The top priority for the new government is addressing cost of living pressures, which have been a major concern for voters this year. Many of these pressures stem from the economic fallout of the COVID-19 pandemic, making it challenging for the government to directly alleviate them. However, many respondents believe that tax changes should provide relief to middle-income earners. National's proposed adjustments to income tax thresholds, although questioned for affordability, are seen as insufficient compensation for the inflation over the last decade. Indexing those thresholds to inflation in the future could lead to a more transparent approach to tax policy. The surge in mortgage rates beyond the government's control, as they're set by the Reserve Bank, is a significant concern for some. A lack of coordination between fiscal and monetary policies over the past 2 years has led to interest rate hikes and continued government spending. A more restrained spending approach might create room for interest rate cuts in 2025. Especially since the Reserve Bank has been quite open with the fact that government spending was one of their major concerns for inflation moving forward. So yeah, it's fingers crossed that the new government is a lot better with their money management, just to say. Healthcare funding has not kept in pace with the growing demand for services. Low pay for healthcare workers has made retaining staff difficult. Capital expenditures needed to upgrade ageing hospitals, education, justice and infrastructure are also pressing issues for New Zealanders. New Zealand's education outcomes have declined by global standards and tertiary education faces challenges. Law and order is a growing concern as well, with a push to reduce prisoner numbers, possibly contributing to increased crime rates. Possibly? I'd say probably. Addressing these issues requires additional funding. Seriously, there's a lot of work that needs to be done to sort out this hot mess that the incoming government has been left with. In New Zealand, infrastructure has been plagued by shifting priorities and inefficiencies. A coordinated approach is needed to maintain the country's infrastructure assets effectively. Housing affordability remains a concern with high house prices relative to incomes and long waiting lists for state housing. Climate change is another critical issue, with the need for a comprehensive and a progressive policy approach. The list of challenges is substantial, unlikely to be fully resolved within the first 100 days or even through coalition talks. Kiwis hope for a positive policy direction from the new government, emphasising the importance of effective delivery. Ultimately, voter dissatisfaction played a role in the recent election results. So we all wait with bated breath to see whether or not the incoming government will be as good as many of us hope they will be. Property investments help diversify your financial portfolio, which protects you from risks and potentially increases your long-term returns. There's no such thing as a no-risk investment, including when it comes to property investing. But if you'd like to learn the best methods on how to invest, join one of our upcoming free events called How to Succeed with Property Investing. As an experienced property investor and a licensed financial advisor, I'll be sharing valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for our events. Alternatively, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. And for those listeners of ours that are already clients, lifetime coaching clients of ours, looking forward to next Wednesday night when we've got our network meeting online with a tax update from Amanda, our recommended accountant. So, hopefully we'll have a bit more policy there from the incoming government after the coalition talks start to take shape. So thanks for listening. See you next week.